Module Overview. Introduction to Capital Budgeting. Capital budgeting, also known as investment appraisal, is the process by which an organization evaluates potential major investment projects or expenditures. These investments could be in tangible assets like machinery, buildings, or technology, or intangible assets such as research and development or branding. Capital budgeting decisions are critical because they involve substantial financial resources and have long-term implications for a firm's profitability and growth trajectory. Unlike routine operating expenses, capital expenditures are significant, irreversible in the short term, and involve a high degree of uncertainty and risk. Therefore, the decision-making process in capital budgeting must be rigorous, systematic, and grounded in sound financial principles. Objectives of capital budgeting: maximize shareholder wealth through careful selection of projects that yield the highest returns relative to their risks, efficient allocation of scarce resources by prioritizing projects that contribute most significantly to the organization's strategic goals, ensure long-term financial sustainability by balancing risk and return in investment decisions, optimize the capital structure by integrating investment decisions with financing strategies, promote accountability by establishing measurable criteria and benchmarks for project evaluation and post-investment review. Types of capital expenditures. Replacement projects. Investments aimed at replacing worn-out or obsolete assets to maintain current operations. Expansion projects. Investments to increase the production capacity or market reach. New product or market development. Investments in launching new products or entering new markets. Regulatory compliance. Investments required to meet government or industry regulations. Research and development. Expenditures on innovation and new technology development. Capital budgeting process. The process involves several key steps: identification of investment opportunities, generating a pool of potential projects aligned with strategic objectives, cash flow, estimation. Projecting all incremental cash inflows and outflows associated with each project over its useful life. This includes initial outlay, operating costs, salvage value, taxes, and changes in working capital. Techniques for capital budgeting analysis. 3.51 Non-discounted cash flow methods payback. Period. Measures how long it takes for an investment to recover its initial cost from cash inflows. It's simple, but ignores time value of money and cash flows beyond the payback period. Accounting rate of return, ARR. Calculates the expected return based on accounting profits rather than cash flows. It does not consider cash flow timing or risk. 3.5.2 Discounted cash flow DCF methods, net present value NPV, calculates the present value of all cash inflows and outflows, using the firm's cost of capital as the discount rate. A positive NPV indicates a value-adding project. Internal rate of return, IRR, 0.0. The discount rate that makes the NPV of a project zero. It represents the project's expected rate of return. Projects with IRR exceeding the cost of capital are desirable. Profitability index, PI. Ratio of the present value of future cash flows to the initial investment. PI greater than 1 indicates a good investment. Discounted payback period. The time it takes to recover the initial investment in present value terms, accounting for the time value of money. Capital rationing and project selection. When financial resources are limited, capital rationing imposes constraints on the amount of capital expenditure a firm can undertake. In such cases, prioritization models like the profitability index and ranking by NPV or IRR are used to select the optimal mix of projects that maximizes value within budget limits. Risk analysis in capital budgeting. Risk assessment in capital budgeting includes sensitivity analysis, examining how changes in key variables, e.g., sales volume, costs, discount rate, affect project outcomes. Scenario analysis, evaluating different possible future scenarios, best case, worst case, most likely case. Simulation techniques, using probabilistic models to estimate the range and likelihood of different outcomes. Real options. Analysis. Valuing managerial flexibility to adapt, defer, or abandon projects based on evolving circumstances. Integration with strategic financial management. Capital budgeting decisions should align with the firm's broader financial strategy, including capital structure decisions, dividend policies, and risk management practices. Successful projects contribute not only to immediate cash flows, but also enhance competitive advantage, market positioning, and organizational capabilities. Ethical and environmental considerations. Modern capital budgeting incorporates environmental, social, and governance (ESG) factors to ensure investments are sustainable and ethically sound. Projects are evaluated for their environmental impact, social responsibility, and alignment with corporate values. Summary. This module provides an exhaustive foundation on the importance, processes, and methods of capital budgeting. It equips learners with tools to evaluate investment projects critically, manage risks effectively, and integrate capital budgeting decisions into strategic financial management for long-term organizational success.